Today, I'm excited to chat about a huge shift happening in global finance that many folks haven't quite picked up on yet, but it's definitely worth your attention. We're talking about Japan making some big moves that could potentially change borrowing patterns in America, set the stage for Wall Street's next crisis, throw currency markets into disarray, and contribute to those pesky rising mortgage rates. And trust me, the final piece of this puzzle is really something special and wraps everything together nicely. Having spent years in one of those big shiny media companies where every story had to fit a certain mold, I watched as inconvenient details got glossed over, important complexities were oversimplified, and the truth often played second fiddle to what kept the advertisers satisfied. I just couldn't stick around any longer, so I decided to break free. Now, I'm running my own show, and I answer to nobody but you. I'm here to bring you the real deal without any spin or corporate agenda. If what I'm sharing resonates with you, I'd appreciate it if you could hit that like button, subscribe to the channel, and consider supporting us. We put in hours of work to cross-check every claim and verify our sources, making sure you're not getting any fake news or sensationalism. That kind of diligence takes time, effort, and resources, and your backing helps keep this independent venture alive. Now let's dive into what's been happening lately. You've probably noticed a lot of dramatic videos circulating on YouTube about Japan and some kind of expected disaster in the US bond market. I completely understand the allure of a little drama. But today, let's take a step back and really unpack the situation. What Japan is doing is far from just another isolated policy change. This is a genuine disturbance shaking up global markets. It's rattling Wall Street, alarming currency traders, and raising some important questions about America's ability to keep borrowing without limits. It all kicked off when Japan's government introduced this massive multi-billion-dollar stimulus package. Analysts quickly pointed out that this wasn't merely a local issue, it could put Japan's financial stability at risk. But here's the catch. It could also have far-reaching impacts beyond Japan. The situation with Japan's economy has taken a serious turn, and it could potentially shake things up for the United States too. Recently, the yen, which is Japan's currency, fell to levels we haven't seen in almost a year, triggering some pretty swift reactions. Japanese finance officials have stepped into the ring, starting to hint that they might need to act to support their plummeting currency. In a recent statement, Japan's finance minister, Satsuki Katayama, sounded the alarm, warning that Tokyo might need to intervene to counter what she described as volatile and speculative market moves. After her words hit the airwaves, the yen experienced a brief surge. But honestly, that little bump didn't change the broader picture. The reality is clear. The yen remains weak, and there's a level of anxiety permeating the markets. Things in Japan aren't just a domestic issue anymore. They're evolving into something that could spiral into a global crisis. Some economists, including Peter Schiff, are raising red flags, claiming that Japan might unintentionally sabotage the US economy. When you dive into the numbers, those warnings definitely make you sit up and take notice. The yen has lost around 6% of its value since Prime Minister Shigeru Ishiba took charge, all thanks to aggressive spending policies. Japan's financial outlook is deteriorating quickly, and simultaneously, the Bank of Japan feels intense pressure to stick with its very loose monetary policy. We've got a situation brewing where there's increased spending and rising debt, but no tightening in sight. That's a recipe for trouble. Now, here's where it gets even more interesting. It's rare to see Japanese government bonds and the yen both dropping at the same time. When this happens, it's usually a bad omen, signaling capital flight, investors making a mad dash to get their cash out of Japan, and serious mistrust in the market, which suggests few believe Japan can get its act together. Some analysts can't help but draw parallels to the UK's bond fiasco back in 2012. That was a mess, sparked by unfunded tax cuts causing chaos in the gilt market. But Japan's predicament is even more critical. The choices being made there have far broader implications for the global economy than what the UK faced back then. As we navigate these developments, I want to know how you feel about it all. Are you worried? Are you prepared? I'd love for you to drop a comment below and share your thoughts. And hey, if you haven't subscribed yet, now's the time to do it so you don't miss out on what's coming next. Let me tell you about some shifting tides that might catch your attention. For a long time, Japan has been like a steady rock for America's finances. buying up more U.S. Treasury debt than any other country. At its peak, they held an astonishing $1.2 trillion in U.S. bonds. That's a lot of zeros, and it basically meant Japan was helping to keep America's spending habits afloat, keeping mortgage rates low and making credit manageable. But those days are over. The yields on Japanese bonds are skyrocketing to levels we haven't seen since the 1990s. In fact, 20-year yields are hitting remarkable heights, and 30-year yields have just nudged above 3.3%. Being at home suddenly looks much better for Japanese investors. This is not what the US wants to hear, especially when you think about who will cover America's skyrocketing government spending now. The fundamentals that made Japan America's largest lender just don't fit anymore. With higher yields back home, Japanese investors stand to earn more there. And don't forget, Japan's aging population is going to want their savings close. New rules are making it necessary for major Japanese insurers to lean heavily on domestic ultra-long bonds, too. In just the third quarter alone, they sold nearly $62 billion in U.S. Treasuries. Some folks might try to paint this as a little portfolio shuffling, but don't let that fool you. This is capital running away from U.S. debt. Wall Street is starting to get it, finally. Analysts from Citi have warned that we could be looking at what they're dubbing a global market Armageddon. Meanwhile, Charles Schwab has raised concerns that the money flowing back to Japan, this repatriation of capital, could push U.S. yields even higher. Many seasoned market players are saying we are witnessing the end of an era. For over 40 years, cheap borrowing in America has been propped up by foreign buyers, especially Japan. And here's where it really hits home. You're already starting to feel the pinch from this shift, even if you don't realize it. Remember when mortgage rates were around 2.6% during the pandemic? Well, brace yourself because they're now creeping close to 7%. Credit card rates have hit record highs, and car loan rates, yeah, they're on the rise too. As Japanese investors pull back from United States treasuries, those few buyers still in the game are pushing for higher yields. That, of course, translates into higher borrowing costs, affecting everyone from consumers to corporations, and yes, even the U.S. government. This situation is something neither party in Washington seems eager to face. Japan is not just momentarily stepping back from U.S. debt. This is not a phase we can easily ride out. We're looking at a structural, lasting shift. Japan's population is rapidly aging, and it's buried under a mountain of debt. That's 235% of its GDP. Just think about that for a second. Their bond market is under immense strain due to endless stimulus, and with a prime minister grappling with a rising economic and geopolitical showdown with China, things are tense. From tourism bans to seafood trade restrictions and military pressures, Japan's got a lot going on. On the home front, Japan's got pressing needs. They require funds for defense, stimulus measures, currency stabilization, and servicing that soaring debt. But here's the catch. Recent bond auctions haven't gone well, leaving the government with limited options. If Japan raises interest rates to bolster the yen, the costs of that debt could skyrocket. Yet if they opt not to raise rates, the yen continues to falter. Each choice seems to hasten the decline of a system that once appeared rock solid. Now let's look at the carry trade, which might sound a bit technical, but is basically a global financial setup focused on borrowing cheap yen to invest in higher yield assets elsewhere. When the yen holds steady, this carry trade supports a whole host of investments, from US stocks to emerging market bonds, not to mention an array of speculative ventures. But if Japan's monetary stability begins to falter, things could spiral quickly. We got a taste of that last year when the S&P 500 plummeted 3% in just one day following a small spike in the yen. With Japan losing grip on both bond yields and currency stability, the chances of a sudden chaotic reversal of that carry trade are growing. If that takes place, we're in for more than just a gentle market correction. We're talking about something potentially chaotic. So, what does this mean moving forward? Americans should start prepping for a reality where money isn't as cheap as it once was. Locking in fixed rate debt is going to be crucial since adjustable rate loans are set to rise along with Treasury yields. There's no escaping that reality. Analysts at BlackRock and Morgan Stanley are suggesting that it's time for investors to mix things up in their portfolios. Think about adding real estate investment trusts, gold, commodities, and alternative strategies. We're entering a period where volatility is going to be the standard, not just a passing phase. Japan's ongoing fiscal crisis isn't merely another tale of budget woes in a foreign land. It marks a critical turning point in global finance. This is where the world's most dependable foreign creditor is stepping back. And it's pretty ironic since it's forcing the United States to compete for global capital at a terribly inconvenient time. We're staring down massive deficits, a level of political division we've rarely seen, rising geopolitical tensions, and higher interest costs. It's safe to say that the 40-year arrangement allowing America to borrow easily while Japan picked up the tab has come to an end. Japan's out of money, grappling with demographic issues, and has finally shed any lingering illusions. For a whole generation, Americans have lived on borrowed time and borrowed money, and that era is drawing to a close. The road ahead is set to be rocky. There's no way around that. The key to weathering this storm is understanding what's going on and why it's happening. That's your first step in preparing for a world where the days of easy money are behind us, and a more uncertain financial future is already here. Now, this isn't something that's going to happen someday down the line. It's unfolding right now, and you should really think about how this impacts your savings, investments, and future plans. To highlight the urgency of this situation, let's recap what we've discussed. Japan, the largest foreign creditor to the United States for decades, is scaling back its investment in U.S. debt, having sold $62 billion in treasuries in just a single quarter. The yen is facing a collapse, and Japanese bond yields are hitting multi-decade highs. The financial logic that once made Japan our go-to lender no longer fits. This shift means that borrowing costs will rise for everyone, from mortgages to credit cards to government expenditures. The carry trade might be in for a rough ride, as we witness the end of a 40-year era of cheap borrowing in America. The consequences are vast, and they're only just starting to unfold. If this analysis has shed some light on the current financial landscape, I'd appreciate it if you hit that like button, subscribe to the channel, and if you're able, consider becoming a sponsor. You know, the work I do doesn't just come together on its own. It takes a whole lot of time, research, and careful fact-checking to connect all these dots. I really appreciate your support. It's what allows me to keep delivering content without bending to corporate interests or advertisers. Honestly, I'm thankful for each and every one of you tuning in. If you have thoughts on what I've shared, drop them in the comments. I truly want to know what you think, and I'll be back with more content soon. But before I go, I'd like to ask you for a small yet significant favor. If you appreciate a voice that dares to challenge the conventional narratives, take a moment to hit that like button and subscribe. It really helps signal to the algorithm that you value this kind of honest reporting over the typical spin. Coming from big networks, I know what it's like to have that safety net, but I chose to step away. Now it's just us. No corporate overlords or big ad budgets keeping things afloat. And I have to say, doing this job right is no walk in the park. It's a daily hustle where I spend hours sifting through the chaos, verifying sources, and making sure to fact-check every little detail. I'm committed to keeping sensationalized fake news out of the mix, unlike so much of what you see elsewhere. Maintaining that level of accuracy isn't easy, and it comes with its own costs. So if this mission resonates with you, I'd love for you to consider supporting the channel. It's more than just financial help. It's an agreement that truth still holds value. It truly means the world to have you along on this journey with me.